Hi, my name is Brittany Kavinsky, and I just want to welcome everyone. It is now 1 p.m., so we will begin our presentation shortly. Today, on June 10th, we will have our presentation on real estate finance from simple to complex, given by Bob Lewis. For help during today's webcast, please feel free to type your questions in the chat box found in the webinar toolbar to the right of your screen, or call 1-800-263-6317. For content questions, please feel free to type those in the questions box, and we will be able to answer those at the end of the presentation during the question and answer session. Here's a list of the sponsoring chapters, divisions, and universities. I would like to thank all of the participating chapters, divisions, and universities for making these webcasts possible. As you can see, we will have a few webcasts coming up within the month of June and July. To register for these upcoming webcasts, please visit www.utah-apa.org/webcast and register for your webcast of choice. I would like to point out that the June 24th webinar, Introduction to the H&T Affordability Index and Applications in Planning webinar, has received CM credit approval. To find a complete listing for 2011 and to register, visit www.utah-apa.org/webcast. To log your CM credits for attending today's webcast, please go to www.planning.org/cm. Select today's date, June 10th, 2011, and then select today's webcast, Real Estate Finance Simple to Complex. This webcast will be available for 1.5 CM credits. We are recording today's webcast and will be available along with a 6-slide per page PDF of the presentation at www.utah-apa.org/webcast archive. At this time, I would like to introduce our speaker for today, Bob Lewis. Bob Lewis is the principal of Development Strategies, which provides economic development consulting and fiscal analysis to clients across the nation. He serves as the chair of the APA Economic Development Division. Bob directs economic research and planning projects at Development Strategies based in St. Louis. He was part of the team that created Development Strategies in 1988 after 10 years with Team 4 and 2 years with the St. Louis County Department of Planning. He was named president in 2011. The focus of his professional work is analyzing the market, economic, and organizational forces that influence urban planning, economic growth, and real estate development. His consulting services yield strategic recommendations for clients seeking to maximize economic value. Clients include local governments, private property owners, corporations, government agencies, nonprofits, and institutions all around the USA. He holds a Bachelor's of Science in Business from Miami University and a Master's in City and Regional Planning from Southern Illinois University at Edwardsville.
Am I on?
Yes, you're on. Go ahead, Bob.
Okay, so you've turned it over to me now, right?
You should have mouse and keyboard power.
Very good. Well, I'm going to start talking, and then we'll find out here shortly. Thank you, Brittany, for the introduction. Pardon me, and welcome everyone to the webinar. I'm going to try to scramble your brains for a while by talking about real estate financing. By the end of an hour or so, you should feel pretty comfortable. That said, you should feel pretty comfortable about the components of a real estate financial pro forma and how to evaluate them. Pardon me. Pro formas have different meanings to different people. Developers see them one way, usually with a positive spin. Investors with those developers tend to be a bit more skeptical, but they want to make money on the deal, so they are always looking at the positive sides of a pro forma. Lenders, like banks, tend to read pro formas with very critical eyes. Banks seem to be more skeptical than equity investors, and we'll talk more about equity investors as we go through this presentation. Banks are more skeptical primarily because they're effectively putting other people's money at risk. Those other people, of course, are the depositors in the bank, like you and me. And these days, banks are even more conservative, careful, and even frightened about real estate ventures. Hopefully that's a short-term phenomenon in the recession, but nevertheless a serious one at this time. And finally, there are folks like us, planners, planning commissioners, city councils, economic developers, who tend to see financial pro formas as well, statistics. These are statistics that seem to be manipulated to the proponent's advantage. You know, there are lies, there are damn lies, and then there are statistics. So we as planners and other representatives of the public interest need to understand how to read and interpret those statistics. Sometimes we have to go out and simply get our own statistics to verify the developer's point of view, or not. And the more that the developer seeks public incentives or public financial participation, the more we need to understand, verify, and challenge the pro forma. Hopefully my down arrow will work here. Maybe it's just going to do this. Brittany, can we get, how do I move the arrow down? Get the next page going. Ooh, that worked. Did I do that or did you?
No, you did it.
Right. Okay. Make sure I'm on the right page. I am. I hit the arrow a couple times, so I'm a little lost, but it should be on page 2, everybody. Here are some key terms we're going to work with. Hopefully we'll get through most of them. But time and complexity may prevent some of that. Note that the word projected is often used. Basically, none of what we're talking about is past tense or even present tense. We are evaluating a possible future development or building. We're going to run through an example of a building here, actually. Effectively, therefore, everything is projected. Of course, it's projected based on sound market analysis, experience of the developers and the planners, and so on, but projected nonetheless. Very important are cash flows. We're running down this list now. Cash flows is jargon for how much money we have left over at some given time. That is how much cash flowed through for our use in another way. Perceived risk is, as alluded to earlier, based on who's doing the perceiving. Developers perceive risk differently from banks who are different from the public sector. There's always risk. The financial analysis, however, helps to determine how risky, to whom, and if there are enough potential benefits to warrant taking that risk. Now, there's many financial ratios bandied about that we see all the time, but we're going to cover a few key ones here. Ratios are extremely important in measuring how well a project is doing or is supposed to do. It's one thing to say that the project will generate, say, $100 million in revenues, but if it also generates $105 million in expenses, the ratio of expense to revenue is not very good, regardless of the amount of revenues and expenses. Capitalization rates are market-based indicators of the ratio between the market value of a real estate project and its net operating income. We'll spend a bit of time in this webinar talking about NOI and cap rates because they're very useful for determining if a project is really worth the effort. And finally, on this page, not finally, but getting down to the end, finally on my paragraph, sorry about that, capital improvements are basically all the money we spend to build a project. That's also cash out. We're spending that money. But much of it is typically borrowed, so it's not necessarily the developer's cash as much as it is the lender's cash. That said, the project has to pay back the loan, so those monthly payments become cash out, thus reducing even more the amount we have left over from annual revenues. And we're going to run through an example to demonstrate all of this with some ratios. Built into all of this is the very important net operating income, or NOI. What we have left over after taking in revenue and paying our expenses tells us how much cash we have left over to pay debts and to pay ourselves back as developers if we're the developers, or to certainly pay back the investors. Let's see if it works now. We're going to change pages now. Let's see if it works. All right, we're getting there, right? Okay, page 3 we should be on. Hopefully everybody's there. It's a little slow. 1, 2, 3. We might not get to a couple of the other thoughts on net present value shown here and internal rate of return. I know we're not going to get to IRR today, given the time allotment, but I do have some slides on net present value if we can get to that. But there's a number of things to cover before we get to that point. So let's move on. Then we'll move on to slide number 4. I'll get the page number 4 here. There's 4. Where's 4? A slow process here. Come on, guys. Do I need some help in moving this down? Brittany, can we get to page 4, slide 4? There we go. Sometimes it works. Some key components of investment analysis here. Actually, this part should be fairly easy to understand for those who've been around a little while. To develop real estate requires there to be some hard costs, which are typically also thought of as construction costs. But there are always soft costs to go along with the hard costs, such as fees to pay architects and lawyers, that sort of thing. There are fees for permits, costs of interest on short-term loans or construction loans, all kinds of sort of non-construction costs, and these are called soft costs in the lingo, and typically amount to about 25%, or the equivalent of 25% in the of hard costs. A little harder to ponder are what I'm calling here transactions and costs. As we prepare a pro forma that matches revenues to expenses, we have to remember that the project is likely to be sold to another party at some point down the road, several years away. None of us buys a house forever. Eventually we sell it. Ideally we sell it for a profit, but in any event it will have a value at some point. In the example we have here, we're going to assume 10 years.
Hey Bob, I hate to interrupt. People aren't seeing the slides right now, so I'm going to go ahead and change it over to you if you can pull them up on your computer.
Oh, sure. So I should bring up my PowerPoint thing.
Okay.
Ready? Get the right one. There. Is that visible? Let me know if that's working there, Brittany.
Okay.
You're the presenter. Show my screen out here. Oh, there we go. Look at that. Is that working?
All right. Yes, I'm seeing it.
Okay. So you're seeing mine, all right?
Yep.
You have a number 4 down at the bottom.
Yep.
Okay, then we're on the right page. I think everybody heard my little spiel about hard costs and soft costs, and you see them listed here. I'm dealing now with the transactions cost. Mostly I'm reminding us all that at some point down the line the developer will likely sell the property and make some big money at the end, although that big money doesn't have as much value today as it does then, or pardon me, whatever. So we're going to deal with a net present value picture in that case. And then very importantly here again is cash flow. Note there are several factors that affect cash flow. Operating revenue means cash coming in, which is a good thing. Operating expenses means cash going out, a necessary thing, of course, but the difference between in and out is less than just the in. So please pay attention not just to revenues that developers say they're going to get, but also what's it going to cost for them to operate that building. What's left over is one form of cash flow. And of course, that cash flow can be negative and sometimes is, especially in early years. And it would be a bad thing if it persists. Capital improvements pardon me, are basically all the money we spend to build the project. That's also cash out. Those capital improvements, by the way, would be hard costs and soft costs. And we'll cover some of that here shortly. It's cash out, but much of it is typically borrowed, so it's not really the developer's cash as much as is the lender's cash. But we got to make payments on that and so on. Let me now shift to number 5. That's a lot easier. Okay. Back to projections. Again, it's all projections, but these are educated projections. These aren't, we're all smart people and know how to figure these out with lots of experience. All the projections have some grounding, or should have some grounding, in market analysis, cost estimating, experience, and so forth. When you're reviewing development proposals, therefore, always ask for supporting research and reports. Make sure that studies have been done. Don't assume the developer is doing exactly what the market will support. Make sure there's some independent analysis. We've touched on hard and soft costs already. Tenant improvement costs, or TI costs, are the expenses that tenants of our building incur to make their spaces functional and attractive. For the most part, tenants rent a box. Then they spend money for carpeting, communications lines, and window treatments, paint, and on and on. Some of this money is paid directly by the tenant, but very often the developer front-ends some of that money as a tenant improvement allowance. I like to think of that tenant improvement allowance as essentially a loan to the tenant from the developer that is repaid through part of the rent. Tenants can negotiate their own levels of tenant improvement allowances, but there are always also certain minimum requirements typically from the developer for such improvements. So the developer wants to provide the money to make sure those improvements are made, although they end up being an expense through rent paid for by the tenants themselves. Contingency is also extremely important as an expense up front to make sure that that there's enough money at least budgeted for problems during the capital improvement stage, the construction stage, that just can't be foreseen. Okay, well, now we're on slide number 6. Now, a crucial financial report at the very beginning of a project is the sources and uses statement. Basically, it tells everyone where the money to build a real estate project is intended to come from and how that money is going to be spent. Some of the money will come from equity, some from borrowing, some perhaps from an incentive provided by an economic development agency or so forth. And we've already covered some of the hard and soft costs on that. Slide number 7. In fact, figuring out the capital expenditures is relatively easy compared to projecting the revenues and operating expenses in the pro forma. This is where the financial analysis takes on a multi-year dimension, although we're not going to touch here on multi-year until late in the slideshow if we have time. The developer and all of the partners, lenders, and public officials need to know how much money is likely to be collected in rents every year and how much is going to cost to operate the building every year. This is not the same as operating the businesses in the building. Such business expenses are the responsibilities of those businesses or tenants. One of these expenses is their rent. The developer or property owner collects the rents and calls it income. But the developer or property owner also has expenses to operate the building, maintaining the roof, for example, and assuring the elevators work, etc. In essence, the property owner is in charge of the common areas of a building, those parts of the building that every tenant shares, like halls and bathrooms, air conditioning system, and the roof. And then slide 8, with rent money left over from such expenses, the developer or property owner has to pay them the debt on the borrowed money that they used to build the building. Making projections of that leftover money, which is termed net operating income, or NOI, tells us how much debt that the project can afford. We'll show you shortly how to figure that out. And of course, there has to be enough money left over even after that to pay the investors back for their investment. Otherwise, they wouldn't do it. They're going to be giving up their money at the front end, so they'll want it back. But there's a time value of that money. Remember, future money is worth less than present money, so the investors will want to recoup not only the money they put in the project, the capital, but the amount that they're effectively losing in purchasing power for not having that money at the present time. We typically think of this as interest payments, but it's more than that in this case, and we'll deal with that as we move along through the webinar. All right, well, I'm starting slide 9, and we're going to use an example here called the Vampire State Building. That's something of a Vampire State Building image up there, but have a little fun anyway. So now you're well versed in some of the important lingo. Let's jump into this example and walk through the various components of the financial analysis. First, note that the gross square feet of this building at the bottom of the slide is 100,000 square feet. As we'll see, this is the gross feet, not that which is rentable, but it's very important for you as a reviewer and analyst of this building to confirm with the developer the number of gross square feet and the net square feet and other dimensions, like the building's footprint on the ground. This little example we've got here has got several stories, so the footprint isn't 100,000 square feet, but maybe only 10 or 20,000 square feet. As we calculate various ratios per square foot through this process, we don't want to be using the wrong denominators. Now here we've lumped the tenant allowance, lost my place here, the tenant allowance with hard costs along with site preparation costs. What are site prep costs? Well, maybe clearing a previous building, or grading of a greenfield site, or even running utilities to a site. There can be a long list of line items under site prep, though I'm not going to list them all here. It's more important that we run through some of the financial analysis, not the things that are actually being spent for. Building construction is typically meant to be just that, from foundation to roof. Lots of line items can show up in building construction, though I'm not going to show you them all here. Typically, we planners and economic developers need to only know what the total construction costs are per square foot. That tells us a lot. There are lots of databases and professionals to help us figure out if such costs per square foot are within acceptable ranges in our market area. A high cost per square foot relative to other buildings might indicate that a developer is trying to pull a fast one on us, or he's developing a high quality building that might be out of range with the market to support, or maybe he knows something we don't know and can get some higher value, which would be a terrific thing for our community. A low construction cost per square foot might indicate a relatively shoddy building, and do we want low quality in that part of our community? So we end up in this case of total hard costs of $10,050,000. Those are just made up numbers, by the way. And then we add in some soft costs, and in this case an extra line item called the contingency. Every good project budget has some amount in the capital budget for overruns and unforeseen expenses, as I mentioned before. In this case, we're calling it 5%. That's a fairly common number of hard costs. And soft costs, I've made 20% of the hard costs. Plus, we need to add in some, then we have development costs there of $12,562,500. Then we actually need to throw in the value of the property itself, whether it's an outright acquisition or not. I hope it's obvious that this is an important cost if the developer has to actually buy the site. But it might be a site that's already owned by, say, a separate property owner, so there would not be necessarily a separate cash transaction to secure the site. Still, since the value of the site is effectively a cost in many ways to the owner, because it's money tied up in land, its market value needs to be included in the overall capital budget. More on market value later. In the end, we come up with a budget for the Vampire State Building of $14,062,500. And this comes to almost $126 per square foot. Is that a steep cost? Who knows in this particular community? But it's wise to check around, though we aren't going to check around right now. Moving to slide 10, are sources of funds. We've talked about this some. Well, we haven't talked about this yet. We talked about the uses of funds. Sources of funds here, private equity, we're just assuming in this project as an example, and this is an example that's a bit complex, and you'll see how that plays out here in a minute. Private equity, we're assuming the developer or the property is throwing in 10% of the project of the capital cost. There'll be a first mortgage from, say, a bank for 65% of the costs. This developer or property owner went and got a separate mezzanine loan, we're calling here, at 15% of the costs, and then has received a public grant for another 10% of the costs. So the total cost, the total capital cost then should match our sources and uses numbers. As I said, they propose a first mortgage loan amounting to 65% of the project. Other than taxes, first mortgages essentially have highest claims to revenues. So the lender is willing, in this case, willing to loan at an interest rate of 7% per year for 20 years. Those are the terms of the loan there. A higher amount and or longer term might make it more risky for the lender, who would then seek a higher rate of interest, or the lender might back out entirely if it's too risky for them. But in this case, it's not enough money for this, what I'm calling complex project, which amounts to, say, a revitalization of an old building in downtown Transylvania. So the owners have obtained some mezzanine financing, covers the gap that he wasn't able to fill with the private lending, for what amounts to a shorter time frame of 10 years and a higher risk indicator of an interest rate of 14%. In all likelihood, this developer tried to get a single mortgage loan but couldn't get the bank to agree to sufficient terms, probably because of some perceived risk in the commercial market right now. So a secondary lender had to be found. As we'll see as we run through some of the numbers, this is a bit usurious, high interest rate mezzanine loan, but nevertheless maybe reflecting something of the risk that is being perceived in the market. As representatives of the public, planners and economic developers need to be skeptical of this project when we see such terms. This particular project couldn't secure all the debt financing it would have liked from the first mortgage. So you should be rubbing your chin and saying, And the investors are only putting in 10%. A more common expectation would be at least 20, and in this day and age, perhaps more than that from the lenders. Again, another and scratching of the chin. And the secondary lender is willing to lend, but only at rather high lending costs, a relatively short term, and a high interest rate. Again, another So you can begin to see why we, the community, have been asked to chip in another 10%. Obviously, this project isn't generating sufficient market interest because of too much perceived risk on the part of the equity investors and the lenders. But the community seems to have said to itself, through perhaps its Economic Development Office and City Council, that it is so important to revitalize this historic building in the core of our community that the community has a vested interest in its success. So let me pause here to ponder the risks involved even to the community. The community has agreed to a grant, and grants aren't repaid. So the community has, in effect, become an equity investor. Still, the community won't be receiving direct payouts of profits. Again, it's a grant. That said, maybe a great deal of the grant is from the federal government. That's nice. You know how grants work. So it may not really be all the community's money. Still, the public sector has agreed to become an investor in this project. What will its rate of return be? We'll talk about rate of return later to the developers, but certainly rate of return to the community is a very important concept. Well, while there be no direct calculation of a rate of return on this 10%, the project may be deemed as helping to spur, catalyze other revitalization in the downtown, which creates more jobs, more tax base. So maybe there's a sufficient indirect economic impact to be claimed by the city as its rate of return for this $1.4 million that it's willing to invest in this project as a grant. And then again, we've got the uses of funds, which we've already been through: the property acquisition, the hard costs, soft costs, the contingency, and it's nice when the sources and uses all add up to the same number. There's no reason why they shouldn't, but make sure they do when you're reviewing these pro formas. Now to slide 12, two critical cash flows is the title. And we're going to starting to head into the pro forma here. Chief among the numbers we want to see is net operating income. NOI has several uses that we'll discuss shortly. But note the kinds of uses that might be built in this building or be included in this building, and how their rents might be typically determined. We're not going to get this complex, but nevertheless, through market research, the developer has determined what kinds of tenants he might seek for this building. Let's say it's a mixed-use project. and how he'll propose to structure the rents. We planners and economic developers need to be familiar with these revenue techniques because it's going to be in the pro forma, and we need to understand the whys and wherefores of where money may be coming from to support this project. For instance, retailers often pay a base rent, just like you or I would pay a rent on an apartment. But they may also pay an additional rent as a percentage of sales above a certain level of sales, say 2% more in rent of gross sales after reaching $150 per square foot in sales. I mean, it can start to get complicated. Hotel operators, as tenants of a building, might also have a base rent, but then they might pay additional or even lesser amounts depending on occupancy and actual revenues. How do we model these metrics? Well, we won't be covering such modeling here, but beware that such complexities will arise. And office tenants typically pay a flat rent negotiated at the time of lease, but there may be escalator clauses, as there could be with the others, to increase the rent each year by a certain amount, or maybe it goes up every 5 years, depending on the lease terms. And they may be, the office tenants may pay rent that covers a number of expenses, like cleaning and real estate taxes, or they may negotiate such expenses out of the rent and have to pay for them separately. This makes the developer's pro forma rather complicated when determining who's paying what rent and what expenses the property owner will be responsible for. And so it goes and on and on. But let's not dwell on these complexities for this purpose today. Instead, we'll assume that the revenue potential is under some control. And we'll move on to slide number, doesn't have a number on it here, but it's pro forma page 1. Let's dissect the pro forma. It's going to take about 3 or 4 pages to do so. We start with a gross square feet of 100,000, but not all of it is rentable or leasable. So we have to determine how much of that space can actually be attributed to rent paid by tenants. In this case, our efficiency ratio is 90%, so we have 90,000 square feet to rent. We or the developer do. The other 10% of that space, or 10,000 square feet, is in common area, or things that just we can't put in a lease for direct rent. From market research, we've determined that we, and I'm saying we as a developer, can get $24 per square foot per year in rent. Again, that's probably determined from all the complexities we just talked about, but I'm looking at an average of $24 per square foot per year in rent. And keep in mind that these kinds of rents are, on a commercial side, are almost always expressed in a per year amount at the per square foot level. Often the residential rents that we talk about are also done by per square foot but per month. Don't confuse the two. You need to make sure you're looking at the right ones. In all likelihood, again, this is a blended average based on a variety of possible tenants and means for collecting rent. But simple multiplication, 90,000 square feet of rentable space times $24 tells us that we can get $2,160,000 in annual rent. Well, that's if the building is 100% full 100% of the time, and if everybody pays the rent on time. In this example that we're going to walk through, therefore, we've assumed a vacancy factor of 5%. So on average, this building of 100,000 square feet will capture rent on 95% of 90,000 square feet, or $2,052,000 a year. That is its effective gross income. All the annual bills to operate this building, to pay the mortgage, and to pay back the investors must come from this effective gross income. In the real world, there might be some other forms of income through fees for special services, interest on investments, but those numbers tend to be relatively small and tend to be quickly offset with some related expenses. And I'm going to keep it fairly simple with just this rental income. Okay, pro forma page 2. I've carried the effective gross income to the top here. And now we're going to pay our operating expenses. Here we show the effective gross income, and then we previously determined, and then we've got some expenses for managing and marketing the building, which in this case we've set at $585,000 a year. And note that I've set it as a negative number in parentheses because it's cash out. Pardon me. I'm not going to go into the details on all that, but we're going to assume that this project will generate $585 in expenses to operate it. We also needed to wisely set aside some money for capital reserves. We had a contingency number in the construction phase, but we also ought to be charging enough rent to set aside some capital reserves. While often not done, it's a good idea, and when we do projects, we budget them. Yes, the building will be newly upgraded under our capital budget, so it may not need many major expenses right away, but in a few years from now, it'll start to need some expensive maintenance. So it's good to have a few bucks set aside so you don't have to go out and borrow more. And that way the improvements become a bit more affordable, and we can pay for them right away, and deterioration isn't allowed to reduce the value of the building. After we paid these expenses, operating expenses out to where they're going, employees, vendors, and such, the capital reserves into a separate bank account, we have left over, in this case, $1,417,000. Nice to have that cash laying around, but remember we need it for other expenses like debt. Meanwhile, we call this the net operating income, NOI. It's because it's the operating income that comes from the operations, the rents coming in and the expenses going out. So it's net because we've netted off the expenses. Remember that NOI number, we'll be visiting that $1,417,000 quite often. Full forma page 3, I'll carry it over that cash flow from operations, or NOI, 1417 again. So now we're going to see how much money we expect by the end of the year. The property generates this $1,417,000, but there was a required annual debt service on those 2 loans. Using a handy formula that's on an Excel spreadsheet, we can easily determine that these loans can be amortized, that is principal and interest payments, for $1,267,200. If you add those 2 lines, those other 2 negative numbers up there. Fortunately, there's enough NOI to pay this amount. After doing so, the property owner now has $149,800 left over with no other expenses. So he pays himself and the other equity investors. In effect, this gives them an annual rate of return on their equity of about 10.7%. Note that we haven't used the phrase internal rate of return or anything like that yet, or IRR. In fact, we probably won't today because we won't have time. But that's reserved for a multi-year analysis of cash flows. Here we've looked only at what we're calling a stabilized year of operations. Frequently, that's what you'll get from a developer, is a stabilized year. Now, let's figure out how the 10.7% return on equity was calculated. Remember that the developer, owner, investors put up about 10% of the capital money for $1,406,300. That's like putting money into a savings account, and at the end of the year you make interest. That's your rate of return. So dividing the $149,800 here for 1 year by the equity amount put in at the beginning of the year of $1,406,000 yields about 10.7% for 1 year's rate of return. Now, using these projected financial figures, the investors then have to decide if 10.7% is worth the trouble. What if they put that same money into the stock market, perhaps at less risk of losing the capital? What if they put it in the U.S. Treasury bonds or municipal bonds, or even a passbook savings account? Could they make more money at less risk? If they could make less money at less risk, does that compensate for the difference in risk? And on and on. They're going to want to avoid putting all their eggs into money eggs into one basket, but they will be evaluating this. At this point, by the way, I would suggest that 10.7% is not a great rate of return for a commercial development of what we're sort of envisioning here, but I'm not going to dwell at that point at this point. We're just going to use the numbers as they are. Still, this pro forma exists on a spreadsheet. We haven't built the building, and it's nice to do some what-ifs. What if, for example, we eliminate the grant but increase the equity 20%? What if the city said no, and the investors had to come up with their own? If you do that, you get a rate of return that basically cuts in half to about 5.3%. They're putting up more of their own money, but still getting back the same amount at the end. What if we could get the mezzanine loan, all other things being equal, at the same terms as the first mortgage? Remember, we were paying on the mezzanine loan We have to pay it back in 10 years at a high rate of interest of 14%. The first mortgage loan was for a 20-year period at 7%. If we could change simply those mezzanine loans, look what happens to our rate of return. It is very impressive at that level. Suggesting that, again, that the mezzanine loan people, as well as the first mortgage people, are viewing this project as fairly risky. Now, leaving everything else the same as it was before and increasing the grant to, say, 15% of the costs, reducing the equity to 5%, meaning the developers are putting in less money, they can get a rate of return of 21%. Now, they're not going to get as much money back because they put in less, but they're going to get they're not going to put in less, but they're going to get the same amount of money back. Let me say that again. They're going to get the same amount of money back, $149,000 or so, but they will have put in less, so their rate of return jumps. Now let's go back to the beginning and we start all over again, but this time we'll increase the grant to 15% and reduce the mezzanine loan to 10% of the project, and even that has a big effect by a rate of return of about 20%. Now, this is why developers will come to the community asking for help in reducing the costs of financing. Ideally, they've been through it with the private sector already. They're investors, the lenders. But even then, they're going to come forward and try to find a way to get some gap financing. This can be a very valuable adjustment in their rate of return. It's called leverage. We'll touch on leverage hopefully later. That said, I wouldn't trust any developer, frankly, wanting to put up only 5% of the project costs. In fact, right now I wouldn't have trusted for 10%. And I'd be wary even at 15%, particularly in today's market. The private lending industry these days wants probably a minimum of 20% equity. That is skin in the game by the guy who's building this project. So why would the public sector expect less? Purposely, we've made this project a little complicated for this webinar, but be skeptical of numbers like we're seeing here. One reason, of course, again, is why the public sector would get involved at this level is that it really, really would like to see that historic downtown building renovated because of its cultural and economic importance in the community. Is that enough? Well, that's another webinar topic, but we'll assume that right now it is. Some financial ratios. Should say number 17 down the lower left-hand corner. I promised some ratios, which is a financier's way of promising you fractions. But fractions or ratios can give us a lot of shorthand information about a project. For instance, the previous sensitivity analysis on rates of return is simply a ratio analysis. What is the ratio of the annual net income to the amount of equity put into the project? If the ratio is unacceptable to the prospective investor, that's a valuable shorthand bit of information. Let's start here with the debt coverage ratio. We touched on this a little bit earlier. It simply tells us if we have enough money after operating expenses to pay our annual debt. Therefore, the debt coverage ratio in this is the NOI, the net operating income, divided by the amount of debt service. In this case, recall that NOI is $1,417,000. That's an annual number. And the sum of our two loan payments is $1,267,200. So our debt coverage ratio is 1.12. In other words, like duh, we have more operating income than we need to pay debt. But that wasn't so hard to figure out. Why figure out a ratio when it's so obvious that 1,000,004 is greater than 1,000,002? Well, that's not the real purpose of the debt coverage ratio. Its real purpose is to tell us, and more importantly the lenders, how much more NOI we have than we need. In this case, we have 12% more, i.e. 1.12. Let's see, we should be getting, there we go. Actually, I'm ahead of myself, but frankly, that's not a large enough ratio in most cases, perhaps all cases of today's lousy commercial markets. Because of the perceived financial risks of commercial real estate, lenders look for a much higher ratio, perhaps 1.4 or 1.5 these days. A few years ago, as we've all experienced, the lending market was a little crazy about commercial real estate and residential for that matter. So very low debt coverage ratios were acceptable, not now. Lenders want to know not only that the project will have more than enough NOI to pay the debt service, but that will have a lot more. This helps assure that the lenders are certain that they'll get their money back. A bad year by the developer can be supplemented with funds reserved from the good previous years. This begs the question, what happens to the surplus debt coverage? If the project needs $1,267,000 to pay debt one year, but the lenders want to be sure that another 50% is in hand, what happens to that 50% at the end of the year? In some ways, it can become payout to the equity investors. But the banks might instead require that that extra 50% go into a separate fund to help pay the annual debt service in a future year when income isn't as strong. There is a business cycle after that. If that's the case, the annual rate of return percentage, that 10.7 number we had before, might not be as good as investors initially thought, at least for a few years. That's why pro forma should have multiple years in them, with occasional assumptions that a year or two will be lousy. Now that's a topic for probably a future webinar. It looks like we won't be able to get to our multi-year analysis today. But we'll be able to convert this stabilized year to a pro forma with a more dynamic multi-year analysis. For now, it's likely that given the pro forma we've just been through, the first mortgage lender is likely to back out, given the rates, the terms we've seen here, with a 1.12 debt coverage ratio. Once that number is known, they might say, nope, not enough safety for us. The mezzanine lender might be more willing to stay in the game, however, because it is receiving a high interest rate and is locking its money up for fewer years, at least compared to the first mortgage lender, who is going to go at it for 20 years. All right, ideally, therefore, the developer must find ways to reduce the debt, the bottom part of this slide. For instance, raising more equity reduces the need for the debt, but are there investors who will help out in these tough economic times? Is the market strong enough to justify more equity? Perhaps more favorable terms for the loans can be negotiated so that the annual debt burden is less. As we saw earlier with some of the rates of return analysis, it does help to get better terms. Or maybe higher rents can be justified. Or, and this is a common or, can some of the uncertainty, some of the market risk be pushed to the public sector? Maybe the city is willing to come up with a bigger grant so the developer won't have to borrow so much. After all, this is an important and catalytic project for the city. Or maybe the city council will agree to guarantee the debt payments if the project itself cannot do so in a given year. How does this help? Well, if the city council agrees to make up for expenses that the developer can't make, it can make the lenders more comfortable that they will be repaid. That is, it reduces their risk. So the lenders, in that case, might be willing to lower their interest rates or lengthen the years of the loan or accept a lower debt coverage ratio. Is it any wonder why developers tout public-private partnerships in order to make deals work better? Let's see. Financial ratios should be a number 20 at the bottom of your screen. The loan-to-value ratio. How about another one? In this case, loan-to-value. We've all heard about this ratio during the recent housing finance crisis. In essence, it tells the lenders whether or not they are lending more money than the project is worth. Remember that the collateral for the loan is almost certainly the building itself. If the property owner defaults on the debt payments, the lenders can seize ownership of the property, but they don't want to own it. They want cash, so they'll try to sell it. So they want to be comfortable that what they're loaning is worth as much or less than the actual project market value itself. Problem is, what's the market value? The easy answer, of course, is what's the market value is the price that a willing buyer will pay a willing seller, but we have neither in this case nor an example. So one way to guesstimate market value is to use the development costs as a proxy for market value. Remember that $14,062,500 that we figured out earlier that are the capital expenses to make this project work. After all, why would anyone develop something that is worth less than the development costs? Well, it happens all the time. And in this case, we might presume that there is a disconnect between value and cost simply because of the public grant They're trying to shore up the costs. It seems like the value may be out of whack. If the market was stronger, there would likely be no need for the grant. But lenders and even the public sector need more confidence in the likely market value. So the lender may call for an appraisal by a qualified real estate appraiser who is asked to assume post-construction occupancy or stabilization as he figures out what the likely market value will be. A preferred technique of the appraisers is to see what similar buildings have sold for recently, then figure out the likely market value of our building based on similarities and differences with those comparable sales or comps. But the Vampire State Building is unique to our downtown, and we're trying to have it renovated precisely because there haven't been any similar downtown sales. Turn it into a catalytic project. Okay, we could check with other downtowns in similar situations. What's been going on with sales in those places? We might compare demographics and employment growth, retail sales, etc. in those cities and see how similar they are to us, then make some judgments about the likely real estate market value of the eventually occupied and operating Vampire State Building. There's an easier way, however, in which actually incorporates all these other transactions in other cities, assuming there have been at least a few. That technique is what we call capitalization rates. They're at the bottom of the slide here. Cap rates from other projects. Cap rates, as they're called, help to summarize market conditions for various types of real estate. New slide. Hopefully everybody's got it. 21 down at the bottom. To estimate the market value of the Vampire State Building using cap rates, we would simply divide the NOI. Yep, we're back to the NOI. I said it's an important number. Divide the NOI by the capitalization rate, which is usually expressed as a percentage, like an interest rate. That's a nice, easy thing to do, but what the heck's the cap rate? Let me illustrate how we would calculate a cap rate for the Vampire State Building. Because I told you that the market value or sales price of real estate can be estimated by dividing the NOI by the cap rate, then the cap rate itself must be the ratio of the NOI to the sales price, which right now we're calling the market value. We simply rearrange the factors in our equation. Granted, we don't know what our market value is, but right now I'm going to just try to illustrate what we will find in the broader market when we find applicable cap rates. Let's figure a cap rate out first. So for the sake of illustration, let's assume our market value is simply the development costs, that $14,062,500. If we divide our NOI of $1,417,000 by that hypothetical sales price of $14,062,500, we get a capitalization rate of 10.1%. Now let's assume that we did not know the market value estimate, but we did know the cap rate applicable in our city. In this case, we divide the NOI by 10.1%, assuming the 10.1% is applicable, and we would end up coming up with that $14,062,500. All right, you're thinking that I just ran you around in a circle to say that A equals B and B equals C, so A equals C, which equals B. What we really need are cap rates that have already been established in the marketplace. Ideally, cap rates that relate to a downtown mixed-use building that has historic value and is being renovated for future uses. I suspect we won't find cap rates that fine-tuned, but nevertheless, we want to find something out there. So here's where your relationships with real estate professionals in your community can really pay off. Call them up. Ask what capitalization rates are currently applying to various kinds of market conditions, be it in a region, maybe your city if it's a large enough city, your state, maybe the whole nation. Okay, it won't be quite as simple for most part because cap rates won't necessarily be available for the specific conditions we're seeing, but we can come close enough to get a pretty good idea of what the market value is likely to be. Cap rates are kind of like bond rates or stock market prices. They fluctuate as the economy fluctuates. Higher cap rates reflect lousier economic conditions, while lower cap rates are indicative of more favorable conditions. Think of them like interest rates. Interest rates rise when things are bad, unless the Fed lowers them, but we won't get into that. Thus, a higher cap rate as the denominator with our NOI as the numerator would give us a lower market value. Lousy economic conditions mean we probably can't get a high price. But better, more robust, more aggressive economic conditions will likely generate more demand for our building, thus pushing up the price. Higher real estate prices are reflected in lower cap rates. Let's see what kinds of cap rates we might obtain today. I simply went on the internet and Googled capitalization rates. I quickly found this chart, which is a blow-up of the one on the previous page. It shows me the trend in cap rates for the year 2010 by quarter for a range of real estate types listed across the bottom. There are national averages based, national averages based on one source of real estate information, a pretty reliable source, but only one source, and you can get this from many places. This source obtains its sales and NOI information from appraisers and property owners and real estate brokers from all over the place in order to calculate basically some aggregate cap rates for these various uses. While this doesn't show, what this doesn't show, however, are regional or local conditions necessarily. The Vampire State Building could be in a medium-sized city in the Midwest, where commercial real estate conditions are far different than in a large growing city on the West Coast. So this chart is useful to us as planners and economic developers, but we should use it only as a guide as we make phone calls to our local real estate professionals and see how we might modify some of these numbers. Already useful from this chart, however, are the trend lines. All of the cap rates shown here trended downward in 2010. If our NOI is assumed to be the same, regardless of the cap rate or the time of the year, then a higher cap rate gives us a lower market value. Remember, the cap rate is a market-based metric for risks, so we would likely see a higher market value at the end of 2010 for our project than we would have at the beginning. These cap rates have all declined, so the national economic forces being what they were, we'd like to be building this building at the end of 2010 than at the beginning. And it probably would be easier to get financing for it. So let's move over here to the cap rates, so slide number 24. I transferred some of these latest fourth quarter cap rates to this chart. It's a little easier to see. One thing these numbers tell us is that on average, office buildings in central business districts seem to have higher market value potentials than those in suburban settings. CBD cap rates here are a little lower. If a CBD building, office building and a suburban office building could generate the same net operating income, then the CBD building would likely have a higher market value. But that presumes the same NOI. Other market conditions would have to be evaluated for actually making that comparison. But that's a sideline. What might be more important to us, how we, what might be important here is that we know we have some estimate of a cap rate for a CBD office building in the United States. Let's assume our Vampire State Building is also mostly office space in a CBD. So for simplicity, let's assume that the Vampire State Building is all office, all CBD, so we'll apply that 7.53% cap rate. Before we do, however, we might end up with something of a blended cap rate if the building is, say, 15% and 15% retail, 85% office, and so forth. To work out that blend of a cap rate, will probably take, you need to call your real estate professionals or get your consultants in with that. Let's keep it simple here for today. Now, market value via the cap rate. Recall that the market value estimate is a result of dividing the annual NOI of $1,470,000 by the cap rate we just set of 7.53%. This gives us an estimated market value of this project of a nice, healthy $18.8 million. This is nicely higher than the development cost we had earlier of about $14.1 million. What if the cap rate was higher? Remember that earlier part of the graph, say the 8.35% in the first quarter of 2010. Well, our market value would then be $1.8 million less. Note the latter half of the slide here. Thank goodness the economy's gotten better, but you can see why real estate buyers love higher cap rates, that is the buyers, and real estate sellers love lower cap rates. Of course, buyers would love lower cap rates, higher market prices, that is, if they thought the cap rates would be going lower still in the future, so they eventually sell high in a few years. Or if they thought the rents could rise above the rate of inflation over some time, while operating costs stayed in check, then the NOI would increase, creating more market value even at the same cap rates. In short, it gets confusing, a lot of moving parts, and welcome to economic analysis, real estate style. Now let me quickly run through a couple of other ratios if I get a little bit of time here. The loan-to-value ratio, very important, takes us back to the, it just does take us back to loan-to-value ratio because we were talking about that beginning with it, and we had to figure out what market value was. This basically tells us the lenders, tells the lenders what the gap is between the amount of loan they are committing and the likely market value. In this case, the ratio is 0.6. 0.60 you see there. So the lenders know they are committing far less than the likely value of this property. Whew, they say. And every year as more debt is paid off, of course, the risk diminishes for the lenders. Unless, of course, the property is badly managed or more competition arises, so rents don't rise like they should. Or the economy turns south again, in which case, NOIs might diminish, or might rise. We don't know what's going to happen. And lowering the marketplace. It's hard to keep up, but we have to keep up to understand what's going on in the marketplace and what's happening to the value of our building. Now, supportable annual debt is another important factor to understand here. So let's tackle this and perhaps finish up with this calculation of supportable annual debt. Haven't we already been given the amount of debt that this project will pay? I already gave that to you earlier. Well, yes. So it's often the case that we don't know what the project can support until we figure out the NOI. So the net operating income is very valuable for figuring out what the supportable debt service is. Remember, the debt service each year has to be paid out of the net operating income. And while we were given the amount of debt early on here, recall that the debt coverage ratio from the ROI at the time was not so high, something like 1.12, when the lenders might demand more like 1.4. So let's assume the requirement is 1.4. That is, the Vampire State Building will need to generate net operating income that is 40% higher than the debt service. Working backward, we can figure out what the supportable annual debt service is. So we divide the NOI by the debt coverage ratio. That's the NOI of the 1,417,000 divided by the 1.40. This gives us supportable debt service of $1,012,100. Mine says 100, but I left the 3 zeros on the chart here. So the supportable annual debt service at that 1.4 debt coverage ratio is less than the debt service that we've been talking about of the $1,267,200. When that happens, the boss comes in and says, what time is it? Time it is, and you tell them it's time to rethink the pro forma. Then, like we did earlier with the rate of return analysis, we might test some other scenarios that better balance debt service, the rate of return, net operating income, loan-to-value ratios, and on and on. That'll likely re-trigger some renegotiation of debt terms, equity requirements, and probably the financial participation of the public sector. By the way, recall that our projection of market value is higher than we might have initially guessed. So the loan-to-value ratio becomes quite favorable. And this might be good news that the lenders and or the city would be willing to talk about renegotiating issues here. So let's wrap it up here. I'm not going to have time to go through the a multi-year analysis, but we'll do that in another time. We'll get the APA to sign us up for another webinar here as soon as we can. We've done enough dumb brain damage, so we've covered a number of key factors, including, assuming a static or stabilized pro forma. Again, not a multi-year thing. We've talked about net operating income, probably the key number, because it has a lot of purposes in a lot of these ratios. We've covered the debt coverage ratio. What's the kind of money we need that the banks are going to require in terms of being able to pay back the borrowed debt. We've covered capitalization rates and a market value estimate based on, again, the NOI. We've covered loan-to-value ratios, and found in this case we might have a more favorable loan-to-value ratio than was originally conceived when that pro forma was put together. Maybe the terms of the loans can be improved. And we've covered the supportable debt. More challenges lie ahead. Again, we'll do a follow-up webinar. We need to look at this on a multi-year basis and then calculate present value and internal rates of return and something called leverage profitability and so forth. It's important to think in terms of multi-years because say you've got a 10-year project, the first year is going to be spending the money to build the thing. There's no income there, but a lot of money going out. There may or may not be a debt service that first year, depending on the rate terms of the loan. The second year, you might not be fully occupied. Maybe you're half occupied as we market and occupy the building. So there's rent coming in, but perhaps not enough rent to cover the expenses for marketing and managing the building at that time. A third year might be better. Maybe you stabilize in year 3 or 4 and hold that for a while. So it's very important to look at the multi-year pro formas and figure out whether the overall rate of return over a period of time makes sense as opposed to simply that one stabilized year. And with that, I'm going to skip through the rest of these and go to questions. Brittany, are we still alive out there?
Yes, we are, Bob. I'm going to go ahead and give you some of the questions that people have been submitting. So the first question, what % of cost is typical to allocate towards the contingency?
The number that I threw in there, I think I threw a 5% number in there of the overall hard costs, or a combination of hard and soft costs, is usually about the right number. Now that can vary depending on the kind of project. Mixed-use projects that have a lot of dimensions in them, retail, office, maybe we've got some condominiums on top and there's a hotel sandwiched in between somehow. Those tend to be the kinds of things that are less comfortable in the investment community, especially the banking lending community. And they may require a higher contingency percentage just because there may be some short circuits that nobody's used to yet. Developers aren't used to those kinds of complexes either, but 5% usually is ample.
Okay, great. Next question, what is a mezzanine loan?
Well, in this case, it's a loan that had to be found from a second lender. Now, mezzanine usually means you're going for a high-risk kind of loan. Ideally, it has a high reward along the way for the lender itself. What was assumed here is that this project had some too much risk going in, so the first mortgage lender looked at it and said, well, I can't afford to lend you everything you want to lend. And in effect, the developer was forced to go find some other money. Theoretically, he or she went out and looked for some more equity money, but it looks just to here the way we set this up, but even that was a little too risky. So he ended up going to a payday loan place or some place that will provide some of this money. I'm making that up. That would be too weird. But somebody who was willing to say, okay, I'll close that gap that you have. And I see, by the way, this is comfortable. You've got a city grant, but it's going to cost you. And so the mezzanine loan really is covering the difference between sort of what the market would have done and what I really need. But often it's at a high price. Ideally, we raise a lot of money through rents and stuff and can pay that off fairly quickly. But that's what a mezzanine would be. something in between normal loan and the full equity.
Okay, great. The next question is, what is the debt service coverage for this project?
What we figured out, at least from the terms that we set up early on, the pro forma that I provided early on, the debt service coverage in this case was, well, looking back, I think it was a number of 1.12. That is 12% more in net operating income than the two loans added up to for their annual amortization number. So the debt service coverage here is 1.12, or 12% more than the loan amount is in the net operating income after paying for the expenses to operate the building. I submit that 1.12 is much too low in today's market. Again, we weren't dealing with a real project here. I was trying to make it a little bit complex so we could play around with some different ways to think about it. So 1.12 is what this project started to show. As at the end of the slideshow, we talked about, well, what if we had to meet a 1.40 debt coverage ratio? And then we worked backwards from the NOI and found out that we can't afford the loans that we have negotiated under that 1.4 scenario. So we got to go back and either drop the project or find some better terms for the loan. But at this point, the project came in at a 1.12.
Okay, great. So what is an acceptable debt coverage ratio? And in the Vampire State Building example, is the grant from the city assumed to be given on an annual basis?
Let's see, annual, probably easier to answer the first question first. No, the grant in this case is assumed here to be a number provided at the capital improvement stage, the construction stage. So it's like borrowing money from the bank or getting equity from your investors. They put it all up right now so that we can pay the contractors and so forth to build the building. So we're assuming in this case it would be an upfront grant. Now that said, it could be structured in other ways, such that the developer might put up that money, but the city says every year for 10 years or 15 years, we will pay you back a certain amount out of grant money to help you with your rate of return on all of that. It can be negotiated any number of ways, and what's the availability of the grant. Typically grants, however, are available one time only and usually come through some special kind of way. So let's just, in this case, we assume it would be handed to the developer to build the building and make this thing work for our downtown. Now, the other question was an acceptable, what was it? Hit me with that again.
What is an acceptable debt coverage ratio?
Oh, I agree. Good question. Talk to your lenders. These days, we're seeing if you're doing say a bank, commercial kind of development like this, we're seeing numbers in the 1.4 range, which means you better have 40% more in your NOI than you need to cover for the actual debt service or the debt repayment that year. 1.4 is a fairly healthy number. Some of them we've seen have been as high as 1.5. But a couple of years ago they were down 0.1, 1.1, a couple of years, 4 years ago, in the 1.1, 1.15 range, because there was so much cash flow, so much economy going that the lenders perceived relatively little risk that they wouldn't get paid. In this case, they're all very nervous about getting paid, so they want to make sure this building is spinning off quite a bit of income to pay that. Even if they don't need that income, they can preserve some of that unused net operating income for a later year to pay the debt service. So I would say 1.4-ish would be an acceptable number these days.
Okay, great. How does this analysis differ for evaluation of single-family development projects?
the single family, let's see if I can easily make that. Typically, in a single family situation, you get a developer that prepares the land and then sells the lots to actual home builders. By the way, the home builder might be the developer too, but we kind of break up the segmentation. You'll see a developer prepare the land, get all the zoning, make sure the utilities are getting to the site and so forth. And then he'll sell off all, and then get it rezoned and get it subdivided. And then sell those subdivided lots to individual home builders, who would then take out their own loans to buy those properties and then build a home and then sell it to an individual property owner. When we're doing big pro formas here for a single family project or a project that includes some single family, we will often treat it either the same way we just walked it through. The terms of the loans might be different because there probably isn't a long-term loan for the developer. So it really would be a short-term loan, even a short-term loan for the home builder, because all they need is the money up front to develop the property or build the buildings, and then they sell the property to a single-family homeowner. That single-family homeowner is the one that comes up with a long-term loan. So it's different, but it can be treated the same as an investment analysis. But in the end, it's probably going to be an easier analysis of the single-family because we're going to spread all that long-term loans, the higher risk loans, to the individual homeowners. Hopefully that got to the point.
Okay, our next question is, what is the best book on this subject matter?
Let me get back to you on that. Because I've been doing this so long, there's so many books, and I hadn't thought about that. I will look up a few, and then maybe I'll send it to you, Brittany, or whatever, or Shana, and we'll get maybe a little bibliography for people to be looking at. I'm just so used to using it. This particular example I adapted from the International Economic Development Council's Real Estate Redevelopment and Reuse Manual, which is part of their professional development courses that are offered quite often. I help teach that class once a year, so that's a pretty good book, and I will put that on the bibliography through the IEDC. But there are some other good examples of it. But by the way, the Urban Land Institute has some terrific information along these lines. So if you are even if you're a planner or economic developer, be perusing not only APA Planners Press for this stuff, but ULI's books and IEDC's books. So I'll get you the bibliography.
Okay. Are there any suggestions for local governments who would like to begin this type of financing but may not have the large amount of funding available for such projects as the Vampire Building?
I'll take it. That's a public sector perspective, it sounds like. Let me just take the perspective that we've got, the city's got some property that it would like to be renovated, redeveloped, rehabilitated, whatever. In those kinds of cases, they may be, a one-out industrial property, a Grayfield old shopping center, or a building that's downtown like the Vampire State Building. Typically, the best way to go about that is to get a consultant to do a serious market and financial feasibility study. During that study, they might be conferring with developers and lenders to get a good perspective on what's the likely risks involved, and therefore interest rates and that coverage ratios and stuff that ought to be working with pro forma. In effect, the city would create its own pro forma and say, we think this project can work at these terms based on the research we've done, and then issue an RFP out to the developer world and say, we've done our analysis, we want this project done, we see these kinds of numbers falling out, We expect you, the developers, who will propose on this site to run your own formas. But we also see there's a weakness in the market, at least early on here, because we've got sort of a rundown downtown or old place. But we think, from our consulting advice, that there's room for us to participate as the public sector by contributing in some kinds of ways, some incentives. Now, and that will sweeten the pot for the developers, lower their risk. What are those ways to contribute? In this case, I just threw in a grant that said, hey, developer, you come in and fix this place up, but we'll give you 10% of the money. That's a nice little incentive, perhaps. Other incentives can include various tax breaks or tax increment financing that might throw in there that helps pay the developer back without risking his or her own money. Simply doing the development yourself as a community can do it. That is, run utilities, subdivide the property, and put the road systems in and so forth. The development itself might be the incentive if you can front end that money with some tax base that you have and say, wow, if we can create this industrial park or a retail center for the actual developers to build above it, we've done all the horizontal work. We'll let them do the vertical work and the managing the building. That reduces the costs and risks to that developer, while creating eventually a tax base that accrues to the city, property taxes, sales taxes, whatever. Here in St. Louis, we get an earnings tax off of it as well. That is, in effect, helps to pay back, maybe ideally more than pay back, for the upfront money that the city put in. So there are a number of ways to think about that, but the research needs to be done up front. What's it take to get this project done? We can do that ourselves as a city to analyze it, run the pro formas. We at Development Strategies do that kind of analysis all the time. And then we find some gaps, like, well, the market's really not going to be able to perform here unless the public sector can contribute the equivalent of, say, 10, 15, 20% of the project. And that can come in various forms. It doesn't have to be a grant.
Great. Our next question is about cost of time delays. Planners or politicians can hold up the project for years if civics complain. Where does that get factored in?
Well, in the soft costs, effectively. That's a correct thing. Now, developers know that. They generally know from experience, and this is experience of millennia, that there are public approvals that have to take place, and that those things can cause delays. Different communities have different reputations for that sort of thing. So in fact, the developer will build that cost of time delays, although some of it's not really a delay as much as it is the cost of doing business if it's the normal process. They'll be built into the soft costs. One of the soft costs that we didn't talk about details, it could be what's called a developer's fee or some other expenses covered for all of that. And they would take that fee when the deal closes and money starts to, the capital money starts to move. And built into the expenses as part of that fee could be this cost of time delays. That cost of time delays, of course, is sitting at planning commission meetings for longer than you need to, having to produce more reports and such and all like that. So it should be built into the soft costs and probably based on the reputation of the community itself. It might also be based on the complexity. You go in with a nice, easy project that's been doing all the time that doesn't require rezoning. It's can go pretty quickly. If the community has, but if it's a mixed-use project, a major redevelopment, is a project in a floodplain or anything like that, it might really start to cause some public consternation. Will slow things down, so you build in more cost, basically, that you want to recover as this project moves on.
Okay. What is cash on cash? Is it a good measure of project viability?
Yeah, that was a topic I didn't get to. It's in additional slides. You may have seen that the words fly by on the slideshow, which is a time thing. basically, cash on cash is a measure of profitability or return. And in our example here, we had cash at the end of the year of what, $149,800 that came out after we paid our debt before we got complicated with the debt service ratio. That's cash in hand to the developer, and the developer put in 10% of the project. $1,400,000 is 10% of the project in cash. So at the end of the year, we got back 149,000 some odd number in cash to help pay for the cash he put up at the front end in the form of equity. So the cash on cash return there came out to, I'm going to remember, I think what did we say, about 10.7%. That's a cash on cash return because it's cash helping pay for the cash. It's not accrued money or anything weird like that. Now that, by the way, begs the question of what's leverage and what's not leverage, another topic I didn't get into here just for time. But quickly, what we're talking about here on this cash on cash return is a leveraged cash on cash return. An unleveraged cash on cash return would be the amount of money left over at the end of the year if the developer put up all the money, didn't borrow anything, didn't get a grant. That means all of the cash was put in there. We didn't leverage it by asking the city for money or trying to get some lenders involved. In that case, the net operating income becomes the cash at the end of the year. The NOI is that number because we don't have other expenses. But the equity up front would have been a lot more, the whole $14 million to build the project. So that cash on cash return that we talked about here, the 149,000 divided by the 1,000,004 or whatever the developer put in as equity, is a leveraged cash on cash return. We'll go into more detail on that in another webinar.
Great. Our next question is, could you just repeat who prefers higher or lower cap rates and why?
Who prefers them? Oh, okay. Well, higher cap rates, higher capitalization rates reflect poorer economic and market conditions, so they reflect lower market values. So a buyer in the real estate market, somebody who wants to go out and buy a shopping center or an office building, would like to see high cap rates because the price of that building will be lower in the market. It also suggests that if it's a relatively high cap rate, that rates will go down in the future. And as they go down, the value of the property in the market goes up. So if I can buy low in the market value or high in a cap rate, I can sell high in the market value and improve my conditions by a lower cap rate. So the buyer would prefer a higher cap rate because it means a lower market value. A seller would be the opposite. They'd like to have a low cap rate, meaning the market value is high, and so the sellers would have to pay more money and I can make a bigger profit.
Okay, great. We'll just take one more question, and we're just about out of time. So our next question will be, how have mixed-use town centers developed under the smart growth or new urbanism principles performed using analysis such as these? Do lenders understand these new developments yet?
The short answer is I don't really know. The longer answer is the early indicators are that it's mixed. The recent, in fact, the current project we're working on right now, which is a mixed-use negotiation with a city and the developer and so forth, suggests very strongly that the lending industry isn't comfortable yet with lending into a mix. They don't mind lending into one component of the mix as long as that one component can be fairly well isolated on the pro forma or on the financial statements. So a lender might lend on be more comfortable lending on the office component whereas another would be, okay, lending on the retail component, another lending on the condominium component. But to get, as we understand it now, lenders are still a bit weird about lending on a project that combines all of those on the one financial statement. Now, that's partly reflective of the relative lack, and by the way, I'm dealing in a Midwest situation here as well, mixed uses that have had some success on the coasts where we've got more have had, or down in Texas or something, have had more success with rates of return. They might be doing better, and I might just don't know in terms of how the lenders react. But mixed-use projects I've worked on around in the greater Midwest area, it gets the financing gets a little weird because we've got multiple lenders who are basically looking at separate components. So, and it's the same kind of pro forma, it's just got more line items for the lenders, and we need to sort of isolate them out on which part they want to get their return from. So I think right now, and in addition, given economic conditions of the prevailing conditions of the last few years and probably the next couple, we're going to see real discomfort on the part of the lending industry with mixed uses. It just seems a little too complex for their balance sheets, and so they just assume to see it not be so complex. I think that's a challenge for us as planners, economic developers, and certainly real estate developers to overcome that, because mixed use, as we all know, is actually a really good way of redeveloping in particular, but also attracting more market dynamics on a 24/7 basis. Okay, Brittany.
Okay, great. Well, thank you, Bob, again for the presentation. It's been really informative. I just want to remind everybody that if your question was not answered or if you have any further questions, you can reach Bob at his email address listed on the slide showing right now. I'm going to go ahead and hand it over to Shana Johnson, who's going to speak a little bit about the Economic Development Division. And then I will go ahead and go through a couple reminders just about logging your CM credits.
Hi, thank you, Brittany, and thank you, Bob, for the wonderful presentation. I'm Shana Johnson, the Secretary-Treasurer of the Economic Development Division, and I'm usually on in the beginning of the webinar and just couldn't get back to my office in time this webinar, but I wanted to encourage all of you to become involved with the division. I manage the webinar series. If you're interested in giving a webinar or have feedback on this one, topics that you want to hear in future webinars, you can email Bob at that email and he'll forward it to me, or you can find my contact information on the Economic Development Division website on planning.org. I also wanted to make a special plug for the division. We're currently looking for a Los Angeles area APA member to be our conference coordinator for the annual conference for next year. And if you're interested in that or interested in at least helping us with the Los Angeles conference, you can email Bob directly. Thank you.
Thank you, Shana.
Thank you, Shana.
All right, for those of you who are still in attendance, I just want to go through a few reminders. First off, to log your CM credits for attending today's webcast, please go to www.planning.org/CM, select today's date, June 10th, 2011, and then select today's webcast, which was Real Estate Finance Simple to Complex. This webcast is available for 1.5 CM credits. Also, we are recording today's session, so you'll be able to find a recording of this webcast along with a 6-slide per page PDF at www.utah.org/webcast-archive. This concludes today's session, and I want to thank everyone again for attending.